Good evening. In today's session, let's discuss regarding monetary policy. But before we go ahead, I would like to tell you the difference between monetary policy and fiscal policy. Many people think that these two can be used interchangeably. No, that is not at all correct. Monetary policy is completely different from fiscal policy. During the course of our discussion, I'll give you all the details. But let me tell you one most important difference between these two. Kindly remember this one. Please write down if you want. Monetary policy is decided by RBI. Monetary policy is decided by Reserve Bank of India, whereas fiscal policy is decided by the Government of India. Please remember these 2 points. Clear? And I will also give you one more point so that you will have a clear cut understanding regarding fiscal policy. For example, if you look at the budget that is presented by the Government of India every year in the Parliament, that is a part of the fiscal policy. Clear? So just remember this one. Fiscal policy is decided by the government. Monetary policy is decided by Reserve Bank of India. Right? So this is the point one. In this session, we are going to discuss regarding monetary policy. And of course, during the discussion, the word fiscal policies may also come into picture. And at that time, we'll have a discussion and we'll be moving ahead. But in this session, we are focusing on monetary policy. Right? So kindly remember, whether it is monetary policy or fiscal policy, everything, these both are related to money. Very, 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 very important. Of course, we already know that when we are discussing about economy itself, this revolves everything around the money. In the similar manner, monetary policy is related to money. Fiscal policy is also related to money. But monetary policy is decided by RBI, whereas fiscal policy is decided by the Government of India. Clear? So with this understanding, let's go ahead and have a discussion on this. Now, when you look at this monetary policy, I told you in the earlier class already that, right, so the concept of money, the money is printed, the coins are minted by RBI, and that will be supplied into the market. So money can be supplied into the market, money can be withdrawn from the market. Hope I am clear. Money can be supplied into the market, money can be withdrawn from the market. Meaning is simple, RBI has the power to pump more money into the market. Same RBI also has the power to suck money from the market. Clear? Depending on the necessity, situation, requirement, demand, RBI takes such decisions. Why RBI will pump more money into the market? Why RBI will suck money from the market? All these things we are going to discuss now, and that will become part of our monetary policy. Clear? Am I clear? So when you say monetary policy of RBI, this is related to the supply of money into the market and sucking money from the market. So let's understand more points now. Look at this closely and clearly. Please write down all the important points. Monetary policy is a set of tools. Remember this one. So when I say tools, these are not the physical tools. These are called instruments, not physical. So these are the strategic instruments. Depending on the situation, depending on the necessity to control something, RBI will take decisions and they will become the part of the monetary policy. Now, monetary policy is a set of tools used by RBI to control the overall money supply and promote economic growth and employ strategies such as revising interest rates and changing banking reserve requirements. So, depending on the necessity, RBI will take all the decisions. So RBI has to promote economic growth. So RBI has to employ strategies such as revising interest rates and changing the bank reserve requirements. What do you mean by this reserve requirements? For example, if you look at any bank, every bank has huge amount of money because people have deposited that. Is that okay? And whatever the money that is present in the bank cannot use all the money and it cannot send all the money into the market. I repeat, a bank has a lot of money. The money that is present in the bank cannot be used 100% by the bank. So bank has to reserve some amount. It has to deposit some amount with RBI. Then whatever is left over, that can be sent into the market by the bank. That is called reserves. That is called reserve ratio. So out of the total money that is available with the bank, how much money has to be reserved with the so-called RBI? That is a part of the monetary policy, right? Depending on the situation, depending on the market conditions, from time to time, RBI will take such decisions. We know what is the a monetary policy committee. That monetary policy committee will decide with respect to the monetary policy. Am I clear? So now basically what will happen, the monetary committee will review these rates every third month. Like say for example, meaning 6 times every year. It has been revised in the month of April, right, 2024. So they will leave 1 month, May, and next review will be in the month of June, right? So after that, next review will be in August, then it will be in October, then it will be in December, then it will be in February. So like this you will have the reviews. So in this session, whatever we are going to discuss now with respect to the reserve rates, the current rates, we are in the month of May 2024. So whatever the information we have with respect to latest revision, that is April 2024, that information I am going to give you, right? The factual information. Otherwise, the rest of the concepts will be same. That will not be changed any time. But for the examination point of view, which you are writing in the month of July and August, APPSC July and TSPSC August. So with respect to you, so we have to update what happened, what happened in the month of June. That I will take care. You need not worry about that. Clear? That information will also be given to you before your examination, right? So next will be July you will be writing the exam APPSC. August you will be writing the exam. So whatever the information, the figures, the statistics you get for the month of June, that may be a question. It's not compulsion that they will definitely ask a question. So they may ask you that question. But otherwise, rest of the concepts are same, rest of the basics are same, rest of the analysis will be the same, and you will be getting larger number of questions from here. And whatever I am going to tell you, please listen carefully and write down and try to understand my analysis. So this is really very important for you to score better. Clear? Now let's go ahead. Monetary policy is the control of the quantity of money. Quantity means the amount of money. So whether you are pumping in 10,000 crores, 20,000 crores, 50,000 crores into the market, that is called quantity. So monetary policy is the control of quantity of money available in the economy and the channels by which new money is supplied into the market. Very important one. Kindly remember this one. Today we have money. We are spending money, we are saving the money. But depending on the necessity, RBI has the power to withdraw the money from the market. So when the RBI is withdrawing the money, then what will happen? The money that is available in the market will be very low. and we will not have money for spending, we will not have money for the savings also. Am I clear? Depending on the situation, RBI may pump in more money quantity, more money will be pumped, so that more money will be available and we can go for the more savings. Clear? Very, very, very important. That is the reason why, if you look at the third line on the screen, RBI through monetary policy will promote economic growth. Am I clear? So accordingly, the RBI or the monetary policy committee will take the decisions. Am I clear? So this is, to begin with. So we'll be going ahead and discuss more points now. Kindly have a look at this one. Look at this now. Next, so we have a question, right? So we love to answer questions, because this is, the very, very important thing, where you have objective type of questions. This will be really, really helpful to you. Which of the following economic statistics influence the monetary policy strategy? Meaning, what are the factors based on which the monetary policy committee will take decisions to review and revise the rates? Maybe repo rate, reverse repo rate, bank rate, SLR, CRR. You might have heard all this, and I am going to explain you each and every aspect to you very clearly in this session only. Clear? Now have a look at this. So which of the following are the economic statistics influence the monetary policy strategy? What do you mean by monetary policy strategy? Whether RBI wants to send more money into the market, or RBI wants to withdraw the money from the market. Is that okay? Whether RBI is asking the banks to reserve more money with RBI, or RBI is asking the banks to reserve less money with the RBI. Both short-term and long-term strategies will be there. Based on that one, RBI will act, meaning monetary policy committee will act. And in this session, whatever we are going to discuss regarding the rates, clear? Whether it is the reserve ratio or the policy rates, everything is decided by monetary policy committee. In that monetary policy committee, I told you already, monetary policy committee came into existence in the year 2016. It consists of 6 members headed by RBI governor. Am I clear? And decisions are taken by majority. Am I clear? Very, very important one. But how do you decide? We are saying 6 members in monetary policy committee. How do you decide about the majority? If 2 members are saying something, 4 members are saying something else, whatever 4 members say, that will be done. Clear? If 1 member says something, 5 members are saying something else, that 5 members, whatever they say, that will prevail. But what will happen if 3 members are saying yes and 3 members are saying no? So there is a equality. There is an equality of votes. In this case, what will happen? Again, RBI governor will have an extra vote in case of equality. So during that time, RBI governor will decide to vote which side. Clear? So whatever he says, that is going to be prevailed. Kindly remember this one. This may also be a question. What will happen? Who will exercise extra vote in case of equality of votes in the monetary policy committee? That extra vote will be exercised by none other than RBI governor. Am I clear? Now, so when it comes to economic statistics, this influences the monetary policy strategy. Gross domestic product, rate of inflation, and industry and sector specific growth rates. So depending on all these, RBI will be changing the strategies, and RBI will be reviewing and revising the monetary policy. So in this question, A, B, C, all the 3 statements are correct. Then obviously our answer should be option 4. Hope you are getting this. Please try to understand every point very clearly and closely. Clear, and this is going to be really a great help to you with respect to the examination. Now, we have another question. I told you already we love to answer the questions. Which of the following statements is or true regarding monetary policy? Is that okay? The RBI may revise the interest rates it charges to loan money to the nation's banks. Clear? What exactly is this? I am going to tell you after some time. But kindly remember, I told you already, RBI is considered to be banker to the government. RBI is also banker to the banks. So meaning, whenever any bank needs money, loan from RBI, RBI will provide the loan. Sometimes what may happen, RBI may also need the money. During that time, RBI will take the loan from the banks. So this is not one way, but this is two way. You please understand this. Am I clear? That is the reason why if RBI is giving loan to a bank, RBI will charge interest rate, right? And the bank has to pay that interest rate. Is that okay? How much is the interest rate? That will be decided by RBI. In the similar manner, when RBI is taking loan from the banks, RBI has to pay interest to the banks. And how much should be paid will be decided by RBI. Very, 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 very important. Meaning, whether RBI is giving loan or taking loan, whether you are accepting interest or whether you are paying interest, everything is decided by RBI. That's the reason why I'll tell you one more point, please understand very clearly. When RBI is giving loan to the banks, RBI will collect higher interest rate from the banks. When RBI is taking the loan from the banks, RBI will pay lower interest to the banks than when it provide loans to the banks. Is that okay? Who is deciding this? Monetary Policy Committee is deciding this. Am I clear? Very, very, very important. So many things are there. We'll understand now. So the statement A is RBI may revise the interest rate it charges to loan money to the national banks. So this is also a part of the monetary policy. As rates rise and fall, financial institutions adjust rates for their customers such as business or home buyers. You might have observed this one very clearly. When you take home loan, so we are paying EMI, right? Equated monthly installments you are paying to the bank. Say for example, you are paying 1 lakh rupees as EMI. Example I am telling you. Suddenly, you will get a notice from the bank that from next month onwards it is revised to 1 lakh 2,000 rupees or 1 lakh 5,000 rupees. So we will be in a shock. Already you said it is only 1 lakh, right? 1 lakh was calculated based on the interest rates on which you have taken the loan. But what happened in between? RBI has revised it. RBI has started charging more interest on the banks. And the banks must pass on to someone. And banks will be passing on to its customers. That's it. And majority of the people do not understand this and they are panicked. They will rush to the banks. So bank will say something. But ultimately what will happen? You need to pay it. And you are paying higher because RBI has increased the interest rates on banks because we have taken loan from the banks at the previous rate. Now you have to pay the extra money. Am I clear? The same thing will happen tomorrow if RBI reduces the interest rates. So then automatically what will happen? The bank will also reduce the interest rates. At the time, the customers are saved. Am I clear? So this is very, very, very important one. So which of the following statements are true regarding monetary policy? both the statements are clear. Both the statements are correct. Is that okay? And try to understand every point very clearly, and you need to focus. Okay, focus with the mind, right? So it should be always alert and aware, so that you will be learning more typical, difficult, complicated concepts in a much easier and lucid manner. Am I clear? Now, so what should be the answer here? It should be both A and B. That's it. Hope you are writing all the points. Write down very clearly. Next. So another important point, look at the first line please. Monetary policy is commonly classified as either expansionary or contradictory or contractionary. I'm sorry, expansionary or contractionary, right? So you know what is the contraction and what is the expansion. Is that okay? So here, so in sciences you might have learned about the contraction and expansion. The same thing is applicable here. Alright? If RBI will go for the contractionary policy, contraction means it is closing its fist. Is that okay? Expansionary means it is opening its fist. When I am saying it is closing its fist, it is tightening the supply of money into the market. When I am saying expansionary, RBI is loosening the supply of money into the market. One side you are tightening the supply, contractionary. On the other side you are loosening the supply of the money, that is expansionary. In expansionary, more money will be supplied into the market. In contractionary, you are supplying less, rather you are sucking more money from the market. Please understand these points very clearly. Clear? That is the reason why. So tomorrow it may be a question. What is expansionary policy of RBI? What is contractionary policy of RBI? Am I clear? Very, very, very important one. If RBI tightens the supply, that is called a contractionary monetary policy. If RBI loosens, that is called the expansionary monetary policy of RBI. Am I clear? Now, look at this. So when it comes to the contractionary policy, this is nothing but increasing interest rates. What do you mean by this? RBI, say for example, RBI is charging, example I am telling you, only example, 6% onto the banks. Example. Alright? And all of a sudden RBI will say it's not 6%, but from now it will be 6.5%. Alright? So depending on the market conditions, RBI has taken a decision. Instead of 6%, my dear banks, you have to pay 6.5% from now. Then what will happen? Right? So then RBI, then the banks will hesitate to take more money from the RBI. So because if they are taking money, they have to pay more interest. If you want to pay more interest, if you need to pay more interest, you have to send more money into the market at higher interest rates. But why the people will take at the higher interest rates? So why the business will take at the higher interest rates? That is the reason why the supply of the money into the market will be halted, restricted, stopped. Then automatically what is happening? Right? So because you are supposed to pay more interest, already the money that is present in the market will come back to the banks, and banks will pay it immediately to RBI. So through the contractionary policy, the RBI is withdrawing the money from the market because you are increasing the interest rates. Am I clear? Look at this. So contractionary policy, nothing but increasing the interest rates and limits. The outstanding money supplied to slow growth and decrease the inflation. where the prices of the goods and services in an economy rise and reduce the purchasing power of money. So what is happening here? I told you some time back, when there is more money in the market, hope you remember, when there is more money in the market, that will lead to inflation. People have money, they have the capacity to spend more, so the prices will increase, and the prices will keep on increasing. One tool that is present in the hands of RBI or Monetary Policy Committee is that because there is an inflation, RBI should also come forward to control the inflation. RBI will employ RBI will apply its contractionary policy, meaning it will increase the interest rates so that the supply of money will be reduced and the money that is present in the market will be withdrawn. When money is withdrawn from the market, what will happen? The purchasing power will come down. Am I clear? So when the purchasing power will come down, if there is inflation, what will happen? Inflation will not sustain at the higher rates. You cannot sell a product at a very higher price when there is low money, when there is no purchasing power. So all of this, then immediately what will happen? The inflation will come down. Am I clear? The inflation will come down, and that is how RBI will control the inflation, through contractionary policy. Am I clear? The reverse will happen when you discuss about the expansionary policy. So what is happening now? So when you go for the expansionary policy, RBI is giving more money into the market. Is that okay? So what happens now? In the expansionary policy, RBI will reduce the interest rates. Instead of a 6%, you pay 5.75%. Instead of paying 6%, I repeat, instead of paying 6%, we are reducing. You pay 5.75%, that is enough. So because you are getting more money at lower interest rates, banks will take more money. Right? And no bank will keep the money with itself. And the banks will send the money into the market. Market means people, market means business. So since the money is available at a cheaper interest rates, business will absorb lots of money. Clear? And people will also take more money, and they will try to purchase homes and cars. Am I clear? And that is called expansionary policy. In the expansionary policy, more money is flowing into the market because RBI has cut down the interest rates. Am I clear? So now what is happening? When more money is supplied into the market, that will lead to economic growth. Am I clear? That will lead to more employment. So that will lead to more GDP. So that is the reason why, depending on the market situation, RBI will go either for the expansionary policy or contractionary policy. Hope I am clear, my dear friends. Very, 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 very important one. So you need to be very, very clear. So during the times of economic slowdown or economic recession, an expansionary policy grows economic activity. By lowering interest rates, savings will become less attractive, and consumer spending and borrowing will increase. Is that okay? When more money is available, the spending will also increase, right? Because the money is available at the cheaper interest rates, borrowing will also increase. That is the reason why all of a sudden you will see in the real estate also, people will start taking more money. So because people will start taking more money to purchase houses for them. That is happening because of the lower interest rates. Who took the decision? Monetary Policy Committee of RBI took the decision. Is that okay? And what is this decision called? Monetary policy decisions. Am I clear? If you are tightening, that is contractionary policy. If you are loosening, that is called expansionary policies. Contractionary policies will be used when there is so much of inflation. Is that okay? And expansionary policies will be used when there is a recession, economic slowdown. Economy is slowing down. Economy is under recession because of the low money into the market. Then RBI has to pump in more money. That is possible only by reducing the interest rates. Am I clear, my dear friends? Now, from here, let's go ahead. Look at the points. Contractionary monetary policy is used to temper inflation and reduce the level of money circulating in the economy. Hope you understood this. Right. Expansionary monetary policy fosters inflationary pressure and increases the amount of money in circulation. Is that okay? They will ask you in the examination when the amount of money in circulation will increase. That will increase only through the expansionary policy. Is that okay? In order to temper inflation, in order to control the inflation, what is the method adopted by RBI? That is nothing but the contractionary policy. Am I clear? You must remember this one. Right? For example, you see, suddenly there is a real estate boom. Why there is a boom? People are ready to buy. Why? People have money. Do they literally have so much of money? No. They can take the loans from where? From the banks. Why banks are giving the loans? Right? So because the bank is getting the loan from RBI and banks are ready to give the money to the people, and banks are charging less interest rate because RBI is also charging the less interest rate. That is called the boom. If it happens in reverse, what will happen? People will stop purchasing the houses. They don't take the loan because the interest rates are high. Then what will happen? The banks will also stop taking more loans from RBI because you need to pay more. Clear? So when there is no demand in the market, what is the purpose of taking more money at higher interest rates? Am I clear? Very, 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 very important one. Right? Next is an expansionary monetary policy decreases unemployment as higher money supply and attractive interest rates stimulate business activities and expansion of the job market. Did I explain you this? Yes. Clear. Expansionary process will go on when there is an economic recession. During that time you need to supply more money. So more money into the market, more opportunities, more industries, more growth, more employment. Clear? That is possible through expansionary monetary policy. Clear? Next. So next, another important one. The exchange rates between domestic and foreign currencies can be affected by monetary policy. Clear? With an increase in the money supply, the domestic currency becomes cheaper than its foreign exchange. So this is another advantage. Is that okay? So since more money is available over there, so that will be leading to more foreign exchange. Right? Next. Look at another question. Which of the following are the goals of the monetary policy? Right? Controlling inflation. Do you agree with this? Right? Decreasing unemployment. Do you agree with this? Stabilizing exchange rates. Do you agree with this? Kindly remember, whatever I taught you so far, based on that you can answer these type of questions easily. I am not saying same question will be repeated in the examination, but the question may be anything, the concepts are same. Please understand this. So whether you are writing higher level examination, middle level examination or any examination, concepts are same. That's what you need to understand very clearly. Is that okay? But the standard of question may be different. So instead of giving 3 statements, they may give you 2 statements, or directly they will give you a question and 4 options from where you will be picking it up, right? But otherwise the subject is same, concept is same, analysis is same, and you need to understand this very, very clearly. Is that okay? So obviously what should be the answer here? Option 4 should be the answer. That's it. Got it? Next. So this is the answer. You please go through this. Right? One more question. One more question we have. We have one more question. This question is related to which of the following is or the differences between the monetary policy and fiscal policy. This is what we have discussed in the beginning of this class. Now let's try. Monetary policy is a tool in the hands of RBI. Okay, we agree till now. It is enacted to sustain a level economy and keep unemployment low. Yes. Protect the value of the currency. Yes. And maintain economic growth. That's it. Whatever the knowledge we have gained so far, we can very confidently say that statement A is 100% correct. That's it. Clear? Because my statement A is correct, 2 should not be my answer and 4 should not be my answer. That's it. Clear? So we have reduced options also to 50% gone. Is that okay? Right? For example, in the examination, try to understand. Say for example, if the statement A is wrong, then what do? Do you straight away go to option 2? Very, very, very risky. If a statement A is right or wrong, you have to read statement B, because there is a possibility the statement B may also be incorrect. Both A and B may be incorrect. Then your answer will become option 4. That is the reason why be very careful in the examination, right? You have to be very, 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 very clever whether to read statement B or not. Am I clear? So in these type of questions, you have to read both the statements, then you can come to conclusion. Am I clear? Right? Next. Fiscal policy is an additional tool, yes, used by the governments. Till here the statement is correct. I told you already, fiscal policy is a tool that is used by the government. It influences the supply of money in the economy and impact market sentiment. Very, 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 very correct here. If you understand very clearly, it influences the supply of money in the market. It is not supplying money. Money is supplied by RBI, but the decisions of the government may influence RBI to push the money. That is the reason why, if you look at the statement, second statement here, second sentence, fiscal policy influences, it is not implementing, it is influences supply of money in the economy and it will impact market sentiment. That statement is correct, right? So statement A is correct, statement B is correct. Obviously our answer should be option 3. Am I clear? That is the reason why you have to read every point in the question. Don't leave any words. Don't leave any word. Every word is important in the examination. So obviously our answer should be option 3. That's it. Clear? Got it? Now let's go ahead. Look at this. So the monetary policy is a policy formulated by RBI and relates to the monetary matters of the country. Right? We know this. The policy involves measures taken to regulate the supply of the money. Yes. Availability of the money. Yes. Cost of the credit in the economy. That's it. Is that okay? That is the reason why the most beautiful thing with respect to any subject, my dear friends, any subject, let me tell you, once you have the clear cut, the command over the concepts, then it will become very easy for you to answer, any question. Am I clear? Right? Look at this. Look at this. The policy also oversees the distribution of credit among the users as well as the borrowing and lending rates of the interest. Yes or no? Right? So depending on the decision of the monetary policy committee, the lending rates will depend and the borrowing will also change. Note, in a developing country like India, we are the fastest growing major economy in the world currently. Am I clear? This we have discussed already. So in a developing country like India, the monetary policy is significant in the promotion of the economic growth. Yes or no? Do you agree with this? Now you are very clear with the concepts. So you should be able to accept these statements. Clear? Next. The various instruments of monetary policy includes variation in bank rates, other interest rates, selective credit controls, supply of currency, variation in reserve requirements, and open market operations, OMOs. I'll tell you what is that. So entire paragraph is correct. Am I clear? Now what shall we do? We'll be going ahead. Right? So in the next sheet, I am going to show you the current rates. Right? Current rates as released by Monetary Policy Committee in April 2024. We are in the month of May 2024. It may be revised again in the month of June, and that will become the latest update for you with respect to your July and August examination for APPSC and TSPSC. Clear? And you also have the civil service examination in the month of June. So with respect to June, depending on the dates, right? So depending on the dates, you need to update. But anyway, I'll be giving you all the updates. Is that okay? And especially when it comes to these, the revisions which occur, every very frequently, meaning total 6 times in a year. So that must be updated from you. So whether you are writing the preliminary examination or the main examination, even with respect to interview, in case of the civil services people, these are really important. Clear? So these are the latest figures. CRR, please write down, note down. Cash reserve ratio, I'll explain you, 4.50%. SLR 18%. Repo rate 6.50%, reverse repo rate 3.35%, marginal standing facility rate 6.75%, bank rate 6.75%. Please note down and remember all this. Right? In the brackets, please write down, this must be updated in June 2024. Is that okay? This must be updated in June 2024 after the review by Monetary Policy Committee, after the review by MPC. Write down, that is enough. Am I clear? And I am not saying that everything is going to be changed. RBI may keep it the same or RBI may revise. Why? That all depends on the market conditions. Am I clear? For example, see my dear friends, how the market will fluctuate. Very recently you have seen there is so much of fall down in the share market. for both Nifty and Sensex. You might have observed this, right? Why? Because the elections is going on, so now the speculations are at a very high level. Whether the same government is going to form the government again after the elections, or the new government will be coming into the power, right? Whether the new political party will be forming the government. Is that okay? So, because of the speculations, the people will try to sell it. So they want to sell it, and that when you are selling, you are taking the money. So when you are taking the money, so large number of people will be starting taking the money. So then obviously what will happen? Market will crash. That is the reason why the prices will come down. Is that okay? No money is available. More money, higher the prices. Less money, lower the prices. Same thing is happening even in the share market. That's it. So this is how you have to correlate all these things. Am I clear? So hopefully you have noted down everything here. Look at this. So monetary policy tools. One is quantitative, second one is qualitative. Quantity, amount of money that you are spending or stopping, that is called quantity. What is qualitative? We'll be understanding now. Look at this. To control inflation, RBI needs to decrease the supply of money or increase the cost of funds in order to keep the demands of goods and services in control. That's it. This is a monetary policy. And it can be of two types: quantitative and qualitative. What are they? Let's try to understand now in the next page. Don't miss out any point, my dear friends. I want you to write down every point, right, in the best possible, shortest way of your choice. I am not saying you please write down like this. Is that okay? But whatever you are writing, when you are revising, you should be able to understand. This is what is more important for you all. Next. So when it comes to the quantitative tools, quantity, amount, whether you are spending or stopping, these tools are applied by the policy that will impact money supply in the entire economy, including sectors such as manufacturing, agriculture, automobiles, and housing. So when it comes to the quantitative tools, this will impact every sector. Is that okay? All right. For example, if you look at the first one, reserve ratio. This is falling under quantity. What do you mean by this reserve ratio? I told you in the beginning of the class, reserve ratio means, for example, if the bank has got 100 crores with it, example I'm telling you, 100 crores with it, all 100 crores bank cannot send into the market. Bank cannot give it to the people or the business with respect to, in the form of loans. It's a compulsion under the rules that every bank has to deposit, every bank has to reserve certain amount with RBI, and that is called reserve ratio. Banks are required to keep aside a set of a percentage of cash reserves or RBI approved assets, that is called the reserve ratio. So this is again of two types. One is the cash reserve ratio, or popularly called CRR. Second one is the SLR. SLR stands for statutory liquidity ratio. In both CRR and SLR, every bank must reserve some cash with RBI. In both the cases, if you are placing some money with RBI, then what is the difference between these two? There is a difference. What is the difference? Let's try to understand now. Look at this. When it comes to the first one, cash reserve ratio. So when you are saying cash, meaning you know the meaning of the cash currency. It need not be cash every time, but it can be in the any liquidity format. Liquidity format means something that can be converted into cash immediately without changing its value. For example, you have securities. So you have Indian Oil Corporation company securities you have, meaning shares you have. You have 1000 shares. That also I am saying liquidity, because at any time you can convert this into cash. You just sell it, immediately you will get the cash. Am I clear? Very, very, very important. So when it comes to cash reserve ratio, banks are required to set aside this portion in cash with the RBI. You have to deposit so and so amount, so and so percentage with the RBI. The banks can, listen carefully, the banks can neither lend it to anyone nor can it earn any interest rate on the profit on or the profit on CRR. So whatever the percentage that you are depositing with the RBI, the so-called CRR, cash reserve ratio, bank cannot lend it to anyone, because you are depositing with RBI. RBI will not pay you any interest, and bank cannot make any profit on cash reserve ratio. Very, 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 very important one, right? I'll just tell you something now. See here. So we are discussing about cash reserve ratio, right? Now just now I told you what is the cash reserve ratio, and our latest rate is 4.5%. Meaning, if the bank has 100 crores, out of that one, 4.5 crores must be deposited with RBI. When money is being deposited with RBI, we expect RBI will pay the interest. But in this case of CRR, whatever the 4.5% you are depositing with RBI, RBI will not pay you any interest. RBI will not pay you any interest. These will be the questions in the forthcoming examinations. Am I clear? That is the reason why if you look at the civil service examination or the group 1 examination, you know the standard of the questions are increasing. So that is the reason why I am trying to teach you in depth, so that you will have the complete conceptual clarity and you will be in a position to answer correctly. Then you will be getting good marks. Am I clear? So this is the CRR. Is that okay? So do the banks earn any profit on CRR? No. This is what we have understood. Am I clear? Also look at SRR is how much? 18%. Sorry. SLR. I'm sorry. CRR, SLR, cash reserve ratio, statutory liquidity ratio. Clear? Next, let's go ahead. Now look at this. So when it comes to SLR also, right? This is also reserve ratio. CRR is also reserve ratio. Reserve ratio means from the amount that is available, you have to reserve with the RBI. In the form of CRR, you are already depositing 4.5% with RBI. Apart from that, every bank has to reserve some amount of money with RBI, and that is called statutory liquidity ratio, and that is 18%. CRR 4.5% deposited. After that again 18% you have to deposit. But what is the difference here? Look at this. Banks are required to set aside this portion in liquid assets such as gold or RBI approved securities, such as government securities. You understood this? Banks are allowed to earn interest on these securities. However, it is very, very low. So another important difference between CRR and SLR is that on CRR, bank is getting no profit, bank is getting no interest. But with respect to SLR, which you are depositing with RBI, the 18%, on that banks are getting profits. Banks are getting interest, but very, very, very low. Am I clear? So please understand this. Next. Look at this. Next, we have another question here. Look at the question. Which of the following statements is or true regarding reserve rates? Reserve rates. Banks are required to set aside CRR portion in cash with RBI. Yes, we know that one. Statement B, right? So obviously this is not my answer. Do you agree with this? Yes, right. So the bank can neither lend it to anyone, yes, nor can it earn any interest rate or profit on CRR. Just now we have understood this statement is also correct. Is that okay? So obviously this is not my answer because B is not there. Am I clear? Right? So when it comes to C, banks are required to set aside SLR portion in liquid assets such as gold or RBI approved securities such as government securities. C is also correct. Is that okay? Can I say option 1 is my answer? No, because this may also be correct. That is the reason why. So during these circumstances, you have to read all the statements very clearly. Don't jump onto option 1. Am I clear? Banks are allowed to earn interest on the SLR securities. Right? So we are very clear now. So my answer should be option 4. That's it. Is that clear? Very, 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 very important one. These kind of questions you will be in a position to answer only when you have clear cut clarity, which you have now, my dear friends. Am I clear? Let's go ahead. That's it. A, B, C, D. This is the answer. Now, let's go ahead. Second one is the, the open market operations. I told you already, we are discussing about the, monetary policy quantitative. So one is the reserve rates and second one is the open market operations. In order to control money supply, RBI buys and sells government securities in the open market. Anybody can buy and anybody can sell it. So this is called open market operations. These are conducted by RBI in the open market and are called OMOs. That is called open market operations. Clear? When RBI sells government securities, when you are selling, you are taking the money. Is that okay? The liquidity is sucked from the market. I don't have to explain this. You can understand now. And exact opposite will happen when RBI will buy the security. When RBI is buying, RBI is releasing more money to the market. When RBI is selling, RBI is sucking the money from the market. Is that okay? And the latter is done to control the inflation, meaning sucking, right? RBI will buy the securities. So when RBI is buying the securities, then what is happening? You are, whenever the inflation is there, that will be controlled. Is that okay? This is to control the inflation, right? So next one. So next one is the note. The objective of open market operations are to keep a check on temporary liquidity mismatches in the market owing to the free foreign owing to the flow of the foreign capital flow. Very important one. This is another purpose of the OMO, open market operations. Clear? Next, look at this. So this is about the qualitative tools. That is over. Qualitative tools are two. What are they? Reserve rates, and second one is the OMOs. Again, in the reserve rates you have the CRR and SLR, and all have been discussed here. So now you are clear with the CRR and latest rate of CRR. You are clear with SLR and what is the latest rate of SLR, right? And CRR will bring no profit to the bank, but SLR is bringing some profit to the banks. Am I clear? So next we understood OMOs also, and that is the end of the the quantitative tools. Now we'll be looking into the qualitative tools, right? Look at this. So when it comes to qualitative tools, unlike quantitative tools which have direct effect on entire economy's money supply, qualitative tools are selective tools that have an effect in the money supply of a specific sector of the economy. Clear? Very important one. For example, real estate. People are buying. Good, no problem. That's really good, right? But suddenly what happened? Because people are buying means they have the lot of money. They have taken the money from the banks. Because people have money, the real estate boom is increasing, meaning prices are increasing. So when the prices are increasing, this will become unaffordable for the people to buy more. Then what should be done? Qualitatively, the RBI will say that the money supply with respect to housing loans, that will be reduced. Housing loans will be increased. RBI will give the instruction to banks that housing loans must be increased, right? So the interest rate on housing loans, if it is increased, people will stop taking the loans. When the people don't have the loans, then there will be low demand in the market. So when there is a low demand in the market, the inflation will be controlled, right? So for a specific sector, if you are controlling, then it is called quality. Am I clear? So how do you do it? One is the margin requirements. RBI prescribes certain margin against collateral, which in turn impacts the borrowing habit of the customers. When the margin requirements are raised by the RBI, customers will be able to borrow less. What do you mean by margin requirements? You have to give more sureties with respect to collaterals. That is a guarantee. That will be increased by the banks, and everybody will not be in a position to provide the collateral guarantee. That is the reason why the flow of the money into real estate will be stopped or restricted. That is called margin requirements by RBI. Got it? Next. Moral suasion. By way of persuasion, the RBI convinces banks to keep money in government securities rather than certain sectors. Right? It will convince that you please, invest money in the government securities. That is called moral suasion. Second one is selective credit control. Controlling credit by not lending to selective industries or speculative businesses. So this is what we have understood. Okay, RBI will say very clearly, don't lend money to so and so sectors. Meaning qualitatively it is using its tools. Is that clear? So monetary policy, qualitative, quantitative. First we understood quantitative tools and now we understood the qualitative tools. Is that okay? Now from here let's go ahead and have a look at this now. So when it comes to the next one, so we have discussed regarding the reserve rates. Now we'll be discussing regarding policy rates. So here you will be coming across with a repo rate, reverse repo rate, bank rates. Clear? So when you are reserving, they are called reserve rates. So this is called the market stabilization scheme. How exactly it is done, we'll try to understand. So when it comes to the bank rate, I told you already, RBI is providing loan to the banks. Is that okay? So when you are taking the loan, you have to pay back the interest. Is that clear? Listen to me very clearly. Very, very important and very simple. Right? So when you are paying back here, how soon you are going to pay back, or how long you are going to take the time to pay back? Clear? So there is something called short term and long term. If the loans are taken by banks for the short term, you are paying interest, you have to pay. If you are paying loan for the long term also, giving the loan and paying for the long term also, so you have to pay the interest. In both the cases you are paying the interest. The only difference is that one is a short term, another one is a long term. One is a short term, another one is a long term. Am I clear? If it is a long term, it is called bank rate. If it is a short term, it is called a repo rate. That's it. Got it? If it is a long term, bank rate. If it is short term, it is repo rate. Right? So now, so before going ahead, I would like to show you something else once again. Let's go back. Look at this. Right? So here we understood CRR, SLR over. Now please look at this. Repo rate 6.5%. Reverse repo rate 3.7, one second. Yeah. So this is 3.35%. Remember this one. Repo rate is 6.5%. But bank rate is 6.75%. Meaning bank rate is higher than repo rate. Repo rate is for short term, bank rate is for long term. That's it. Right? Very, very, very important one. So when it comes to repo rate, my dear friends, this is paid. This is RBI. RBI is giving loan to a bank. So then obviously this bank has to pay interest to RBI, and whatever you are paying short term, that is called a repo rate. So whatever you are paying on that one, you have to pay 6.5% interest to the RBI, that is called repo rate. But if it is a long term, that is called bank rate, and bank rate is 6.75%, because it is long term. One is short term, but the purpose is same, one and the same. Clear? Over? If you are comfortable, I'll be going ahead. So when you say reverse repo rate, right, this is just opposite to repo rate. So right, in the repo rate, what is happening? RBI is giving loan to bank, and bank is paying interest to RBI, right? And for that, RBI is charging 6.50% interest. Sometimes what may happen, right? RBI needs money, and it will take money from the bank. So money is flowing from bank to RBI in the form of loan. When RBI is giving the loan, the bank is paying the interest. When RBI is taking the loan, RBI should also pay interest to the bank. And that interest rate is called reverse repo rate. And this is 3.35% only. Hope you got it. If RBI is giving the loan, it is charging more. When RBI is taking the loan, it is paying less interest. That is called reverse repo rate. Who is deciding all these things? Monetary policy committee is deciding all these things. Look at this very, very clearly. Am I clear? Very, 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 very important. Got it? Hope you got it now. So we'll be discussing these points now. Kindly wait for a while. I'll take you to the page where we have stopped. This is what we are discussing, right? So the interest rate at which RBI lending long-term funds to banks is referred to as the bank rate. Is that okay? However, RBI does not entirely control money supply via bank rate. No. So this is not controlling everything through bank rate. That is the place where the repo and reverse repo are coming into picture. It uses a liquidity adjustment facility, repo rate as one of the significant tools to control over money supply. Is that okay? So just now we have discussed repo rate is 6.50, right? I'll ask you one question now. If RBI increases repo rate from 6.5, it is increasing to 6.75%. Is it a contractionary policy or expansionary policy? Just think about it. It is a contractionary policy because you are restricting the flow of the money. So this is a method where RBI wants to suck the money from the market because there is inflation. Am I clear? Similarly, I will ask you something. Right, a repo rate is 6.50 now. If it is reduced to 6.25%, what will happen? The interest rate that is supposed to be paid by the bank has come down. Then more money will be released into the market. Banks will take more money, more loan from the RBI, and more money will be sent into the market. Clear? When it will happen? When there is a recession. Am I clear? And this is called expansionary policy. Very, 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 very important. Is that okay? Bank rate is used to prescribe penalty to the bank if it does not maintain the prescribed SLR or CRR. Right? I told you already what is CRR, SLR. These are the amounts that must be deposited with the RBI. Is that clear? If any bank fails to deposit or reserve CRR and SLR as per the decision of the RBI, whatever the gap that is there, that amount will be considered as a bank rate, and on that one the penalty will be imposed. You have to pay interest rate to the RBI. Clear? And this is how the bank rate is being used. Am I clear? Two purposes. One is for long-term loan, long-term lending, and second one is the gaps of the CRR and SLR. Whatever the gap is there, that will be treated as a loan, and on that one you have to pay the bank rate. Clear? Very, 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 very important one. And currently the bank rate is 6.75%. Now look at this. So when it comes to liquidity adjustment facility, you have a repo and a reverse repo rate. RBI uses a liquidity adjustment facility as an instrument to adjust liquidity and money supply. Clear? And this will happen through repo rate and reverse repo rate. Clear? Repo rate comes into the picture when RBI is giving loans to banks. Reverse repo is coming into the picture when banks are giving loans to RBI. That's it. Just read. I'll give you 30 seconds time and let's move to the next page. Clear? Got it? Look at this. So next is the the so-called marginal standing facility rate. So this is a penal rate at which a central bank lends money to the banks over the rate available under the repo policy. So banks availing MSF rate can use a maximum of 1% of the SLR securities. Is that okay? So in case of the failure of the SLR, so this marginal standing facility will be that will be given, and on that 1% will be charged, and that is called the marginal standing facility, right? So next comes the dear money policy or contractionary monetary policy. Already we have discussed, clear, that is also called dear money policy. Sometimes you read in the newspaper, the prices of the vegetables has become dearer, right? So dearer means the price are increasing. So when there is a price increasing, that is called inflation. When there is an inflation, RBI will apply contractionary policy, that is called dear money policy. Am I clear? So whenever there is an inflation, RBI will be applying the contractionary policy. Am I clear? That is the reason why in the government employment also you will see employees are paid DA, dearness allowance. What do you mean by this one? So based on the the price rise in the market, so they will also be provided with the dearness allowance, only to see that the employees will not be under trouble and they should be able to match their income with the price rising. That is called the dearness allowance. Is that okay? Right. So this policy leads to a drop in business. I'll tell you this one. Dear money policy is a policy when money becomes more expensive with the rise of the interest rates. Contractionary policy. Due to this, the supply of money is also decreased in the economy. Therefore, it is also referred to as a contractionary monetary policy, which we know this one. This policy will lead to drop in business expansion owing to higher cost of credit, as well as a fall in the business expansion. This in turn affects the employment as it brings down the growth rates. Consequences are there. Therefore, interest cuts such as SLR and CRR are preferred by the government and corporates. Why? If SLR, CRR are cut, then the amount of money that is deposited by the banks in the RBI will be coming down. More money will be available with the banks to send into the market. So hope you are getting this. Very, 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 very important. So they can send more money into the market, and that will eases the economy. More supply, more growth, more employment. Am I clear? Next. So this is called the dear money policy. Next is the fiscal policy. Anyways, we are going to discuss in an elaborate manner later, right? And let me tell you a few points here. A policy set by the finance ministry that deals with the matters related to government expenditure and revenue budget is referred to as fiscal policy. How are you getting the revenue? Raising the loans, tax policies, service charges, non-tax matters, right, such as disinvestment. All these are bringing revenue to the government. Is that okay? So when it comes to expenditure, it includes salaries, pensions, subsidies, funds used for creating capital assets like bridges and roads, right? So the government expenditure and income put together is called the fiscal policy. Am I clear? Through expenditure, government is spending and government is sending money into the market. So that is with respect to salaries, loans. Is that okay? And government is going for the capital expenditure like building bridges and roads like that. Is that okay? And government is getting income through the disinvestment, meaning selling its share from the public sector undertakings, and government is getting more money through the taxation, both the direct and indirect taxes. Am I clear? So this is the fiscal policy, some information for you, and as I told you, we'll be discussing more during the discussion on fiscal policy. So now we have two concepts here. One is the demand pull inflation. Demand pull inflation and supply side inflation. Is that okay? Another very important point. As we know, inflation means the persistent rise of the prices of the commodities over a period of time. Multiple reasons are there why there is inflation. Inflation may be because there is so much of demand. Inflation may be because there is so much of because there is something to do with the supply. If you have something with the demand which is leading to inflation, that is called a demand pull inflation. So when it comes to supply, that is called supply push inflation, where RBI is coming into picture, where government is coming into picture. Let's try to understand now, right? So when it comes to demand pull inflation, this is a state when people have excess money to buy goods in the market. Demand is more, people have the money, right? And that is leading to inflation. Clear? Then RBI practices easier control on this, as it can lead to a fall in money supply in the economy, which in turn would mean a drop in the prices. So in order to control demand pull inflation, RBI will step in. Listen to me carefully. You know what is inflation. Inflation can be controlled by RBI. Inflation can also be controlled by governments. But the point is, my dear close friends, when RBI steps in, when government steps in, where RBI cannot step in, where government cannot step in. These are the points that you should know. Am I clear? That I am going to tell you now. Is that okay? So when there is a demand pull inflation, the demand is more for the goods. That is the reason why the prices are increasing. That is leading to inflation. In order to control inflation, what will happen? RBI will step in. This is the demand pull inflation. The RBI will step in, and RBI will apply monetary policy. It will restrict the flow of the money into the market. It will try to suck the money from the market. When the money is sucked, the spending capacity, purchasing capacity will come down, people will not purchase, and when the demand is coming down, automatically the prices will be under control. Meaning, RBI will step in when there is demand pull inflation. Government cannot do anything here. But government will come into the picture when there is a supply side inflation. Is that okay? There is some problem with the supply. Only few products are being released. And then what is happening? That is also leading to inflation. Why? Only few products are available. Demand is more, right? And the supply is pushing the inflation. This is not because of high demand, because people have the high money. No, that is not the case. Because the supply is less, right? The supply is pushing the inflation. It is not demand pulling the inflation, but supply is pushing the inflation. Then government will step in. Look at this. Inflation in the economy owing to constraints in the supply side of the goods in the market. This cannot be controlled by the RBI. If there is no supply, RBI will not enter into the market and give some, the concession to the, the industries. That will be given by the government. So RBI cannot step with respect to supply side inflation, as it does not control the price of the commodities. Prices of the commodities must be controlled by government. That is the reason why when onion prices have increased, then the government will, impose the restriction, no exports. That's it. Clear? So the government plays an important role on this through fiscal policy, meaning demand pull inflation can be handled by monetary policy. Supply side inflation or supply push inflation will be controlled through fiscal policy. Please remember this. Am I clear? Next. Look at this. So objectives of the monetary policy, now you understood very clearly, right? So economic growth as well as the price and exchange rate stability, right? Apart from this, there are also other aspects which you can understand very clearly, and it will be promoting savings and investments. Yes, since the monetary policy controls the rate of interest and inflation within the country, it can impact the savings and investments of the people. Higher rate of interest translates to greater chance of investment and savings, thereby maintaining a healthy cash flow within the economy. Over. Controlling imports and exports. By helping industries securing a loan at a reduced rate of interest, monetary policy helps export-oriented units to substitute imports and increase exports. This in turn helps improve the condition of the balance of payments. So these are all the advantages, benefits with respect to, the monetary policy. Some more are there. We'll have a look at this. Look at this now. Managing business cycles, right? So if you look at a business, there may be a boom, there may be a depression, right? So what do you mean by this? Economic boom, economic depression, right? So when there is a boom, you will see a lot of money in the market. Real estate boom, stock market boom, bullion boom, meaning gold, right? So there is a depression in the stock market, depression in the real estate, everything is falling here. Is that okay? So there are two cycles, right? So every time you cannot expect boom, every time you cannot expect, the depression. Clear? Monetary policy is the greatest tool using which the boom and depression of business cycles can be controlled by managing the credit to control the supply of the money. When there is a depression, go for expansionary policy, release more money into the market. When there is a boom, then what should be done? Control, contractionary policy, so that you are controlling the inflation. So the inflation in the market can be controlled by reducing the supply of money. On the other hand, when the money supply increases, the demand in the economy will also increase, will also witness a rise, right? Hopefully, my dear friends, you are able to follow very, 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 very easily, right? Look at this next one. Regulation of aggregate demand. Since the monetary policy cannot control the, since the monetary policy can control the demand in an economy, It can be used by monetary authorities to maintain a balance between demand and supply of the goods and services. So by monetary policy, you can maintain the balance. Is that okay? So how do you control this one? Control the inflation by using monetary policy, and that will be maintaining the demand and supply, right? When credit is expanded and the rate of interest is reduced, it allows more people to secure loans for the purchase of goods and services. We know that's one. This is leading to increase in the demand. On the other hand, when authorities wish to reduce the demand, they can reduce the credit and raise the interest rates. That's it. Clear? So I need not explain you this one because you already understood large number of concepts very clearly and closely, right? And this is also helping in the generation of employment. How? So when you are releasing more money to the market, you are providing an environment for the establishment of industries, right, which require the manpower, and the people who are unemployed will be employed now. Helping with the development of infrastructure, it allows concessional funding for the development of the infrastructure within the country. Great. Allocating more credit for the priority segments. Under the monetary policy, additional funds are allocated at lower rates of interest for the development of the priority sectors such as the small scale industries, agriculture, and underdeveloped sections of the society. That is the reason why when you are giving the loan, what should be the percentage you can charge, that will vary from bank to bank, and that will be decided by RBI. Is that okay? Say for example, when you take personal loan, car loan, home loan, right? So agriculture loan, industrial loan, the loan will vary, right? So you are getting money only, but the percentage that you are going to pay back will vary, and how much it should be, that will be decided by the RBI. Is it clear? Next, look at this. So managing and developing the banking sector, the entire banking sector is managed by RBI. While RBI aims to make banking facilities available far and wide across the nation, it also instructs banks using monetary policy to establish rural branches wherever necessary for agricultural development. Clear? Additionally, the government has also set up regional rural banks and cooperative banks to help farmers to receive the financial aid they require in no time. So what is the meaning here? So you need to provide loans for agricultural development, and our agriculture is present in rural areas. How do those innocent farmers will come to the urban areas for the purpose of loans? So the process is totally cumbersome for them. Then obviously what happens, they will be, the government has established the RRBs, regional rural banks, in the rural areas, and accordingly the RBI is giving the instructions to the banks with respect to providing loans with respect to agriculture. Am I clear? So these are all being done because of the proper monetary policy by monetary policy committee. Clear? Next, right? So repo rate I already discussed with you, right? Look at this. So this is also known as the benchmark interest rate. This is the rate at which RBI lends money to the banks for a short term. Is that okay? Simple points, you already know this. When it is increased, borrowing from RBI will become expensive. If RBI wants to make it more expensive for the banks to borrow money, it will increase the repo rate. Similarly, if it wants to make it cheaper for the banks to borrow money, it can reduce the repo rate, and currently it is 6.5%. Is that okay? So this is what we have already understood. We will be going ahead now. So next is the reverse repo rate. Clear? Already we have understood, right? So right is the short term borrowing rate at which RBI borrows money from the banks. Is that okay? And RBI uses this tool when it feels there is too much of money floating in the system, and an increase in the reverse repo rate means the banks will get higher rate of interest from RBI. As a result, banks prefer to lend their money to RBI, which is always safe instead of lending it to others, which is always risky. That is the reason why if repo rate is increasing, banks will always try to deposit with the RBI only, because the banks also know very clearly lending it to outsiders is really risky. Got it? Now, repo rate signifies the rate at which liquidity is injected in the banking system by RBI, whereas reverse repo rate signifies the rate at which the central bank absorbs liquidity from the banks. Repo rate, you are supplying the, you are sending money into the market. Through reverse repo rate, you are absorbing the liquidity from the market. That's it. Clear? Next. Right? CRR already we have discussed. Is that okay? Right? And you know every point. Just to go through this one. Since we have already discussed, just look at these points. Right? Fine. Next is the SLR. This also we have discussed. And kindly remember one point. The maximum SR limit can be 40%. Please remember. Currently how much? 18%. But maximum it can be up to 40%. Am I clear? Next. Right? So these two are another very important words that you should remember. So you go to a bank and you have opened an account. So in your account you got money. Clear? And when can you take your money? So when you are depositing your hard earned money into a bank, bank has a responsibility to give back at your money, to give back your money at your demand. Meaning, bank is liable to you. Bank has to pay. So when you are opening an account, you have every right to take back your money at any time you want. And bank is liable to you. That's it. If any such facility is there, that is called net demand liabilities. Am I clear? Your own account in a particular bank and you can withdraw money at any time, that is called net demand liability, meaning on the moment you demand, bank is liable, bank has to pay you. That is called net demand liabilities. Is that okay? When it comes to time liabilities, which you cannot withdraw immediately, your money, say for example fixed deposit, right? And some conditions will be there that you can deposit, you can withdraw money only after 1 year. So today you have deposited, you have fixed deposited, say 10 lakhs. So those 10 lakhs you cannot take it immediately. So there is a time liability. We are liable to give you, but not now. Still there is a time after 1 year. That is called time liability. Is that okay? And with which one you are very comfortable? Net demand liability. Bank accounts from which you can withdraw your money at any time, like your savings accounts and current account, that is called a net demand liability. Even from current account also we can withdraw. If you are in a business, your account is called current account. Clear? If it is personal, that is called a savings account, and from both the accounts you can withdraw at any time, that is called a net demand liability. But when it comes to time liability, bank accounts where you cannot immediately withdraw your money, but you have to wait for a certain period, that is called a time liability. Hope you got the difference, right? Please write down very clearly and carefully. Next, call rate. What is this? Interbank borrowing rate. RBI is giving loan to banks, meaning banks are taking loans from RBI. RBI is also taking loans from banks. Can a bank take loan from other banks? Yes. One bank is lending, other bank is borrowing. That is called interbank borrowing, and that is called call rate. Should you have to pay interest on that? Yes, obviously. Is that okay? Interest rate paid by the banks for lending and borrowing funds with maturity period ranging from 1 to 14 days, that is called call rate. Right? So this call money market deals with extremely short term lending between banks themselves. Extremely short. Maybe for 1 day, 2 days, 3 days, but not beyond 14 days. And that is called call rate. Very, 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 very important one. Is that okay? Next. Next is the, marginal standing facility. It is a special window for banks to borrow from RBI. Apart from other methods like, repo rate and bank rate, right? Marginal standing facility is also a facility where banks borrow from RBI against approved government securities in an emergency situation like an acute shortage of the money. Is that okay? So we need money urgent. Bank has to send money into the market. Bank has no money, but it needs urgent. Overnight it requires money. And that facility is called marginal standing facility, where banks are taking loan from RBI overnight. Should you have to pay anything for that? Yes, you have to pay 6.75%. Is that okay? And another one, as we have discussed, that is a bank rate. Is that okay? Repo rate for a short period, bank rate for a long period, and bank rate is also 6.75%. Right? So bank rate is 6.75%, right? And so-called, this marginal standing facility is also 6.75%. Am I clear? Next. So you have a question now. Which of the following statements is or true? 3 statements are given. Central banks use monetary policy to manage economic fluctuations and achieve the price stability, right? It means that inflation is low and stable. Fine. RBI set explicit inflation targets in Indian economy with inflation targeting. Inflation targeting. Write down this word. Inflation targeting means it is using monetary policy to target inflation, to temper the inflation, to bring down the inflation. All the 3 statements are correct. Then our answer should be option 4. Alright. That's it. Clear? So this is about, my dear close friends, regarding monetary policy. Right? And remember every point, and please revise every point what you have written as many times as possible, because lots of complexities and difficulties may appear. Right? When you are listening for the first time, one time, that's okay, right? You feel, you may be feeling that is so easy, but it's not easy. Am I clear? That is the reason why I took enough time to explain, right? So in a lucid manner, so that you will be, understanding very clearly, right? I did my best, and I want you to do your best. Thank you so much, and I will see you in the next session.